afternoon. My name is Kent Scorney. I'm President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your April market perspective. John, great to be with you again.
Nice to be with you.
Always surprising how quick a month goes by before we're back here recording some of your thoughts and your team's thoughts on just really what's happening in the economy, maybe some geopolitical items, and then of course market and how that relates to everyone's portfolios. So where do we begin? I think that when I listen to the the financial news, I always have to remind myself that negative news sells.
Yeah.
And that's always something to worry about when you're watching the news, because it can really take you down. There's lots of things to talk about today. I mean,
there are
earnings recession, the Fed, bank issues,
Yeah.
Lots of things happening. What's your take?
Yeah, it's a really good point to start out with. It's important to not get sidetracked and distracted by the day-to-day noise. There's plenty of things for the market and investors to worry about. I would argue much of that is probably in price. When you think about geopolitics, whether it's Russia, Ukraine, or China, Taiwan, U.S., China relationships, the debt ceiling discussion and the political divisiveness that's kind of in play as we speak. The Fed talking very hawkish on inflation still, likely to raise rates here next week, yet another time, probably the final time. Earnings slow down.
Yeah.
There's plenty. I think, it's important for investors to recognize, though, that much of that is often in price. And as we begin to work our way through earnings season, here we are 30% of the way through, we're seeing a lower bar. So expectations have been set lower, but percentage of revenue beats and earnings per share beats is not too far different than the 5-year average historically. It's a little bit below, but not significantly. And so there's this fear or expectation that there's another shoe to drop,
Right.
and they're just not be.
Just not happening
Right.
yet. Right. And
Right.
I think that's what we always say to ourselves is it going to happen? When's it going to happen? And it just might not happen.
It just might not happen.
Yeah.
It just might not happen. If we look at retail sales, for example, they're higher than they were 3 months ago.
Right.
There's plenty of economic indicators that are softening. We follow the Atlanta Fed GDP Now print, which is kind of an ongoing real-time assessment of GDP expectations. And a month ago, Q1 GDP was at 3.3. It's now at 1.1. So there's definitely slowdown happening, but it doesn't mean that things have to unravel. And I think the stability around earnings, not only now, but forecasted earnings as we get into later of the year, there's some signs of stabilization. That could change quickly. I think what's changed over the last 4 to 6 weeks since we probably did this last video is that the tighter lending and pulling in the reins from the banking system is real. That has a tightening effect.
Absolutely.
Leads into higher unemployment. We're seeing that anecdotally, I feel like, every day in the media. We probably know folks in our community that are experiencing layoffs. And so that has a spillover effect, right? Tighter lending conditions, higher unemployment and greater job loss, slower spending shows up in earnings potentially at some point.
And yet, we will sit with an entrepreneur just like we did yesterday and hear that their business is crushing it still.
Absolutely.
And might be crushing it for the next couple of years.
That's right.
So we'll hear, sort of different stories depending on where you are, where you sit in this economy, whether you're an employee, a business owner, executive, what have you.
It's very mixed.
I think that's the big takeaway I take is that it's a mixed bag out there right now.
It's a mixed bag, and it's easy, I think, to your point earlier around the financial media. It's easy to have a glasses half empty outlook and assume the worst and actually extrapolate all the concerns for the market into portfolio strategy. They just need to be separate.
And I think that's where the challenge is, right? So we listen to what's happening in the financial markets, geopolitical, the economy, everything. But then what does that translate into how you're managing money, how you're managing portfolios?
Yeah, they're definitely different. The market typically has the advantage of seeing things ahead of the curve. I take the bond market, for example. There's a extraordinary disconnect between what the Fed's expectations are for rates and what the market is pricing in.
Right, the bond market disagrees with the Fed, right?
That's right. That's right. And the Fed, the recent track record has not been great.
Right.
And so the market typically, especially the bond market, typically is a pretty good indicator of what lies ahead, and it's signaling slowdown for sure. The 2-year Treasury versus the 10-year is inverted. Typically, the recessionary indicator is the uninversion.
Yes.
There's still about a 50 basis point spread, so it's conceivable that against all odds, this market can push higher. That doesn't mean volatility won't still exist and we won't see lower prices, but it's also not a foregone conclusion that the October lows won't hold.
Right. And speaking of volatility, I think the correlation between the asset classes inside a portfolio are really important to how you all manage portfolios.
Yeah, it's really important. That's one of the things that we're highlighting significantly right now. Investors should have, it's kind of the classic saying, there should always be something in your portfolio that you're not in love with or that you hate.
That's right.
Because
on the contrast, there's probably something in your portfolio you love.
Right.
Yeah.
Right. And don't get too anchored to that position or positions either.
Right.
Yes, introducing negative to non-correlated exposures is really important. As Paul Gabriel, our head of fixed income, likes to say, there's income again in fixed income. So short-term yields are higher.
Yep.
The CD and Treasury environment on the short end is attractive again. We've talked about that prior conversations, but beyond that, there are segments of markets broadly that can dampen volatility, that can introduce low to non-correlations to equities, and that's important because if there is another shoe to drop at some point, which that economic deterioration can happen fast and
fast and furious.
It's reasonable for price to follow at some point if that unfolds. It's important to have a diverse mix in the portfolio.
You were having a conversation earlier today, actually, with a client about international versus domestic. Can you speak to that a little bit?
It's we've gone through, if we think about the last 12 years, we've gone through a number of fits and starts that the broader investment community was thinking this is the time where international will start to reemerge in more of a outperforming position, and it hasn't happened really this entire cycle. We are noticing a change of character, though. Jamie Setley, our head of technical research, as you know, of course, is talking a lot about the technical setup in international markets, looking more enticing than it has in the last 12 years. And developed foreign relative to the S&P. S&P is at an interesting point that we would contend on a multi-year view is setting up nicely. And it makes sense if you look at the catalyst, the collective catalyst, for why that is. We've got a peaking U.S. dollar, so a likely weaker U.S. dollar going forward. We've got valuation support out of the international markets. You've got 12 and 13 PEs out of emerging markets and developed foreign versus 18 plus domestically. You've got significant underweight positioning by U.S. investors with home country bias. It's been the best place to be for the last, since 2009, so you can't blame them. But we'll remind folks of 03 to 07. It was an environment dominated by international.
And for many years there, we were wondering if the U.S. would actually wake up and connect and catch up with the international space.
Right. Dividends yields, cash flow better often.
Yeah, just interesting who or what tends to lead in certain market conditions.
Yeah. It'll go through fits and starts, but there are attractive signs that on a longer term basis that's an important consideration.
You talk about Jamie Setley, Paul Gabriel in the bond market.
Yeah.
Any other unique things you're seeing out there?
Jake Thornton and Dan Laritz on the fundamental and quantitative side spend a lot of time looking at earnings and breaking things down. And, I would just echo what I said earlier. There's no evidence of an unraveling at all at this point. And, we know from plenty of historical references that we expect the S&P to have bottomed before the trough in the earnings numbers and the data.
Right.
And
because it's just such a great predictor of earnings.
That's right.
So we're not hearing a lot of doomsday talk from you all, but we're also not hearing this market's going to take off on us.
Right.
So that tells me, as an investor, you got to work hard for your returns.
Without a doubt.
You got to check your risk profile, make sure your risk profile is set up appropriately for what your financial plan and your wealth plan states. And then make sure the portfolio is allocated appropriately, correct?
That's exactly right. Yeah, that's exactly right. I would, those three takeaways I think are spot on. I think the first is don't let your economic views dictate your portfolio decisions, because the market is typically a step ahead.
Right.
The second is do take time to step back and assess overall risk. You'd rather do that now when the S&P's up 7% year to date than than being in the low 3000s.
Yeah, that's right.
Which is conceivable. I mean, the math fits together for that to happen.
Right.
It's not a base expectation, but possible, of course. And then the third component of that is the diversification piece and knowing how the components fit together and work with one another.
That's great. Well, thank you, John. I appreciate it, and thank you for allowing us to spend just a few minutes with you today in our April market perspective. As always, we thank you for the opportunity to be stewards of your wealth. And if you have any questions, please contact your wealth advisor here at Krilogy. So for John MacArthur, I'm Ken Scornia. Have an amazing day.
Thank you.